Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Ferris Bueller said, "Life moves pretty fast. If you don't stop and look around once in a while, you could miss it." Now, Ferris Bueller came out in 1986, and I feel like his observation is even more poignant today, as we are buried under an avalanche of information that floods us every waking moment. Life is moving really fast, and we have a front row seat. We see all of it. It's like sitting on the shoulder of a busy highway, and we see all of these cars speeding by. And sometimes we have to slow down. I remember when CNN headline news came out in the early 1980s. It was 1982 to be exact. And, it was pretty revolutionary because back then we had to wait for the news. That's a weird concept today, right? But in those days, most people, they got a morning paper and that pretty much told you what happened yesterday. And then you had to wait until evening to find out what happened when you watched evening news. You might get an update on some kind of breaking news if you happen to be listening to the radio, or, if it was a really big deal, the networks would break in. It was a special report, and you knew there was some kind of big news that was going on. But for the most part, through most of the day, you didn't really know what was going on beyond, the life that you were living in that moment, in that place and time. So with the advent of cable news, we got what became known as the 24-hour news cycle. And, it seemed fast back then, but today in the internet era, a 24-hour news cycle seems pretty quaint, antiquated. Now we have, a 30-second news cycle brought to you by X or whatever other social media platforms you care to peruse. Yesterday morning, I had all of this April CPI data within minutes of its release. That wasn't possible when I was a kid back in the 80s. Today, we often know things are happening within a moment, right? Everybody has a camera and on their phone. We have the internet. Information can spread around the world in a matter of minutes. If a war breaks out, in Europe, we're going to know about it pretty much as it happens. And I don't think that people really realize how much this has changed the way we react to information, right? We have to operate on such fast time frames. Our decision making has to be so fast that I think a lot of people have kind of lost their ability to look at the big picture, to think strategically. Everything is a reaction to the latest piece of news, the latest piece of data, the latest thing that we saw on X. And really sitting back and reflecting and contemplating and looking at, kind of putting things together in a cohesive way. I don't think a lot of people are good at that in this day and age. And I'll give you an example of how this speeding up of information processing has also sped up decision making. So when I was in journalism school, I took a class on reporting on war, really, really good class. And we kind of looked at how media has reported wars in the past, going all the way back to the American Revolution, and then moving into the present and how it's changed and whatnot. And one of the things we talked about was this very process of things speeding up. And the example the professor used was when they started building the Berlin Wall. And of course, this happened in the 40s after World War II. And as it turns out, the U.S. military, the president, the decision makers in the United States knew that this wall was being built about a week or two before the general public. That's how slowly information moved back in those days. Now, there is a little bit of an advantage to this from a decision-making standpoint, because people have time to kind of look at things and reflect before they react. Whereas today, when everything is moving so fast and the general public knows everything that's going on, there's much more pressure to make fast decisions. And I think fast decision making can sometimes lead to bad decision making. But policymakers have to, because they're under this constant pressure. They can't wait a week. If some country's building a wall across a city, they can't wait a week or 2 weeks to respond. Whereas back then, they could wait that long because nobody knew. There wasn't so much pressure. There wasn't so much anxiety to do something now, right? And I think this same kind of decision-making phenomenon is relevant when we talk about investing, right? Everybody is hyper-focused on the latest data point, the last headline, the last word uttered by Jerome Powell or Donald Trump or whomever. There is very little strategic planning and reflecting. Everything was caused by something that happened 30 seconds ago. And I see this all of the time when I'm, looking at social media threads and you'll see, a data point about inflation. And immediately it's Trump's fault if you don't like Trump, or it's Biden's fault if you don't like Biden. Nobody stops to think that maybe it was somebody's fault 10 years ago, because that's such ancient history today. And again, I think this can cause bad decision making. We can't totally base all of our decisions on what happened 30 seconds ago, because we have to put it into some kind of context. Because obviously, everything wasn't caused by something 30 seconds ago. There's a bigger picture that we always have to look at. Now, I'm not saying it's not important to keep up with the latest news or the most recent data release. I'm not even saying that we don't sometimes make decisions based on those things. But you always also have to be aware and take time to slow down and put things into context. I'll give you an example in the financial world. Over the weekend, Trump announced a breakthrough in trade negotiations with China. Tariffs are going to be rolled back at least for 90 days. And with this news on Monday, the stock market took off. Gold sold off. Gold was down more than $100 early on the day, Monday. And, by Tuesday, people were now canceling the much feared recession, right? On Friday last week, there was going to be a recession. Everybody was convinced, there was all this doom and gloom. And then Tuesday, that was over, thing of the past. There was a big headline on Bloomberg declaring JP Morgan drops U.S. recession call after U.S.-China trade truce. And JP Morgan wasn't alone. All of a sudden, all of the tariff worry is over and everything is great. The economy's fine now. Is it though? Recent history tells you it isn't. Today, there's a trade truce. Tomorrow there might be new tariffs. The current administration is nothing if not unpredictable. I get it. It's a negotiating tactic. I understand how Trump is using tariffs, but that doesn't help people who are trying to make longer-term decisions. Do you really trust that the trade war is over? Or do you keep preparing for tariffs? Who knows, right? We don't know what Donald Trump's going to come out and say next week, much less a month or two from now, and that makes it very difficult to do long-term planning. But, beyond that, do you really mean to tell me that the only reason there were recession concerns was tariffs? Was it smart to sell gold on Monday? If you're just considering tariffs, I guess maybe. But aren't there maybe some other reasons for holding on to your gold? Yes, right? This is why Asian investors are stocking up on gold right now, even as Americans seem more interested in selling and taking some quick profits. So if you listen to the show regularly, you know this. There are other underlying factors, in my view, that make a recession not only likely, I would argue inevitable. And I've talked about it over and over. This economy is a debt-riddled bubble waiting for a pin. Tariff policy might be the pin. But even if it isn't, there is a pin out there with this bubble's name on it. Heck, the tariffs might have already pricked the bubble. It may already be losing air. And that brings me to a key point. Economic policy generally takes a long time to play out. right? I mean, I've gone over the timeline of the 2008 financial crisis several times on this show, so I will refrain from going through it all again. But, just a reminder to keep in mind that the interest rate peak that ultimately popped the real estate bubble, that peak interest rate was in 2006. They were cutting rates in 2007. And we didn't have the financial crisis until the end of 2008, right? We didn't really see things play out for nearly 2 years. Now, we're not even 2 years out from the last rate hike in this cycle, so there's that. As an investor, you have to factor in these big picture things. And I think a lot of people in this day and age have a really hard time doing that. Think about this. Many of the people out there in the world of finance that are working on Wall Street or, in Chicago or wherever, they've worked their entire careers in an artificially low interest rate environment. They can't fathom 20% interest rates like we saw in the 1980s. And I think that drives a lot of decision making. There's just this assumption that these 4 or 5% interest rates are abnormally high because in comparison with, the entire decade of the 2010s, they weren't. It was zero. The fact of the matter is 5% isn't even the average American interest rate through time. That came out to be around 6%, or that comes out to be around 6%. But after the Fed kept rates at zero for a decade, right, and barely got them up to 2% before they cut them to zero again, people just have come to believe that's how it's going to be. Easy money is the way. And they can't really picture it being different because that's the environment that they were in. I had the privilege of interviewing Jim Grant a few weeks ago, and I've said this before, he's one of my favorite market analysts out there. I love his insights, and I just think he has a way of words. If you haven't listened to that interview, I encourage you to do so. I'll link to it on the show notes page. But Grant believes we are heading into a secular bear market in bonds that will be marked by much higher average interest rates. Now, we're not talking about, 6 months or a year. We're talking about, again, a secular market, long. We're talking about decades. Why? Well, he believes this because he's looking at the trends, and the bond market has historically moved within this very expanded cycle of 20, 30, 40, 50-year trends. And again, that's hard for people who typically operate in a 30-second news cycle to fathom. And, by the way, if Jim is right, that's pretty awful news for a government that depends on artificially low interest rates to fund its profligate borrowing and spending, right? A bear market in bonds is not something that the U.S. government is really equipped to cope with at this point. I mean, we're on track for another year of trillion-dollar interest payments just on the national debt. The U.S. government is currently on a monthly basis paying more on the national debt than it is for national security, Medicare, Medicaid. The only spending category right now that's higher than interest expense on the debt is Social Security. And we're talking about a bear market in bonds. That's why it's important to look at these longer term trends because that's going to be relevant 4, 5, 6 years from now, not just tomorrow. So really quick, I want to hit on 3 long-term trends that I think investors should keep on their radar as they try to make sense of the data deluge that hits them in the face on a minute-by-minute basis. And the first thing is debt. Right? You probably notice I like to call the current economy debt-riddled. I call it a debt-riddled bubble economy. And I'm not using hyperbole, right? It is a debt-riddled economy. Just think about the national debt, over $36 trillion. Now, if you're just following the 30-second news cycle, you might think that the problem's been solved. I mean, the federal government ran a big surplus last month. I wrote about it yesterday. And I actually saw some people out there in the world of social media claiming that Trump fixed the deficit. No, there was a surplus last April too. There is a surplus in most Aprils. It's called tax day, right? Every April, the government gets a big influx of money as people file their taxes. And it was compounded this year with tariff receipts. Now, before you start emailing me saying, see, tariffs are great, keep in mind, as I understand it, the whole point is to use these higher tariffs as a negotiating tool and then get them lowered, right? The plan, I don't think, isn't for, high tariffs into perpetuity. So if that's the plan, then the extra revenue that the government is getting from tariffs is temporary, right? Meanwhile, the real problem has been and continues to be unrestrained government spending. We don't have a revenue problem. The U.S. government's bringing in more money than it ever has, but it's spending more money than it ever has. The Trump administration blew through $591.77 billion in April. That was 4.4% higher than April 2024 spending. At $4.16 trillion, spending is up 8.9% through the first 7 months of fiscal 2025. The fiscal year budget deficit, we're 7 months into the fiscal year. The deficit right now is $1.05 trillion. It's 22.8% higher than it was through the same period in fiscal 2024. So no, the problem's not solved, right? You get one surplus. That doesn't mean that there's no more deficits. Again, you have to look beyond the 30-second news cycle. And of course, when we're talking about debt, it's not just government debt. We got the latest consumer debt figures late last week. Americans are still borrowing money, but the pace of borrowing has slowed significantly. And record levels of consumer debt are apparently starting to stress people's finances. Surprise, surprise. You run your credit cards up to the limit, it strains the budget. So after crashing in February, consumer borrowing was pretty tepid again in March, and that is a worrying sign for an economy that runs on credit cards. I mentioned that stress on Americans' budgets. They're struggling to pay those high credit card bills. It's interesting because even though we've had the rate cuts, credit card interest rates have not gone down much at all. They're still almost at the record levels that they were as we were peaking out the Fed rate hikes. But according to the New York Fed, in the fourth quarter of 2024, aggregate delinquency rates ticked up 0.1% from the previous quarter to 3.6% of outstanding debt. So 3.6% of outstanding debt is in some stage of delinquency. According to Payments Intelligence, credit cards are the loan type with the highest shares of balances 90-plus days delinquent, and that's currently at 11.5%. That's a lot. It's over 10% of people with credit cards are 90-plus days delinquent. According to Credit Gauge, consumer credit delinquencies hit the highest level in 5 years in 2024. Quote, the combination of rising mid to late stage credit delinquencies and rising credit balances suggests a growing debt burden that some consumers are increasingly struggling to manage. Right? That's the problem with running an economy on credit cards. Credit cards have a limit, right? There's only so much borrowing you can do before you have to pay the piper. So that's a bigger relevant trend that people need to look at as they're considering where the economy's heading. And then there's corporate debt, right? Bankruptcies are rising. They're at levels that were last seen during the pandemic. Companies are being forced to refinance huge piles of debt at much higher interest rates. So we have this massive debt bubble in government, in consumer debt, in corporate debt. What happens to bubbles? Bubbles pop. Now, it can take a while for a bubble to pop, but the pressure isn't going away. And this is one of the reasons people are begging for interest rate cuts. It's why you've got Donald Trump kind of badgering Jerome Powell, saying we've got to cut interest rates. We have an economy that is addicted to easy money. It's addicted to borrowing, and if you're addicted to borrowing, you need low interest rates. But the pushers over at the Federal Reserve took the easy money drug away to fight the inflation dragon, and now the addict wants to get high again. So that's what's going on bigger picture. And this leads us to a second factor that I think people really need to be aware of, and that is inflation. Now, this is another thing, if you're just watching the headlines fly by on X, that you might think, well, the inflation problem is fixed. The ugly truth is, despite what the CPI tells you, price inflation is not dead, right? Prices rose 0.2% last month. That was both the CPI and the core CPI. And That's relatively tame and compared to what we saw, a couple of years ago. But still, that annualizes to 2.4%. Now, again, not awful, but it's still nearly a half a percentage point higher than the target. And keep in mind, the target is to devalue your money 2% every single year. I've said this before. Inflation is not a mistake. It's not just something that mysteriously happens. It is a policy. They are intentionally devaluing your money every single month. Sometimes it's worse than others, and that's their goal. They don't want to get rid of inflation. They just don't want you to notice, right? But if you're looking at the CPI numbers, they have definitely cooled over the last year. There's definitely been improvement, and that's led a lot of people to believe, okay, inflation is dead. But here, again, we are confronted with an educational problem because people don't know what inflation is. It's not just rising prices. That is a symptom. Inflation is an increase in the supply of money and credit. Do you realize how much the Fed and the government increased the money supply during the pandemic? Nearly $5 trillion just in quantitative easing. And that was on top of the $4 trillion in quantitative easing during the Great Recession that was never unwound, despite assurances that it was an emergency policy in response to the financial crisis. All of that is still on the books. And then on top of that, you have nearly 2 decades of artificially low interest rates, 0% interest rates for 10 years, helping to pump up that debt bubble. That is an increase in the money supply and an increase in credit. That is inflation. That used to be what we meant when we said inflation, and they've redefined it to just mean rising prices, which is a symptom of this monetary inflation. Anyway, when you start talking about trillions of dollars of money creation, that's a lot of money, a lot of inflation that's still bubbling around out there in the system. Just because it's not showing up in the form of higher consumer prices right now doesn't mean it's not there. And I bet if you look closely, you could probably find a place where there is extreme asset inflation, the stock market. And here's the thing. Despite tough talk on inflation, the money supply has been increasing for almost a year. That is, by definition, inflation. Now, that's not going to show up in the CPI until later if it shows up there at all, right? Because monetary inflation can manifest in different parts of the economy. But there is inflation. It is out there. And again, inflation is the policy. They're just trying to control it. So this combination of debt and inflation is the source of the catch-22 that the Fed is in and that I've been talking about on the show since the first of the year. The Fed needs to simultaneously keep rates higher, right, to fight inflation, and it needs to lower interest rates because we have all of this debt. Well, raising and lowering interest rates at the same time is not a thing. So you can take tariffs completely out of the equation, you're still getting a bad answer, right? There's still inflation risks because we have this massive debt bubble and a interest rate environment that is the product of monetary malfeasance. Third factor I wanted to touch on real quick is de-dollarization. Now, no, I don't think we're going to wake up tomorrow and find out that the dollar is no longer the reserve currency. This is not the kind of thing that suddenly becomes a headline on X, right? Because it's playing out over a long period of time. Now, every once in a while, people will get interested in it, and you might see a flurry of stories about it. But de-dollarization is happening. It is slow, but it is relentless. It's a trend that's playing out over time. And it's extremely important because it has significant ramifications, right? A lot of people believe that we're moving toward a multipolar world where the dollar plays a much less dominant role. Dollar doesn't go away, right? It doesn't crash. It may even still be the main reserve currency, but it's not as dominant as it once was. This is one of the reasons so many central banks are adding gold to their reserves. They're replacing dollars with gold. And I've talked about this before. Even a small decline in dollar dominance could be significant to the U.S. economy because the global financial system runs on dollars. The world needs a lot of dollars, and the United States depends on this global demand for dollars to underpin its bloated government. One of the reasons that the Fed can do $5 trillion in quantitative easing is because the world soaks up a lot of those dollars because they need those dollars for global trade. Well, what happens if the world suddenly doesn't need as many dollars? They're going to come back to the United States. And what does that do? It increases the money supply domestically. And what does an increase in the money supply do? It causes price inflation, rising consumer prices. The point is, the only reason the U.S. can borrow and spend and run massive budget deficits to the extent that it does is the dollar's role as the world reserve currency. It creates this built-in global demand for dollars and dollar-denominated assets. And this absorbs the Federal Reserve's money creation, helps maintain dollar strength despite inflationary policies. But again, what happens if the demand drops? And the demand is dropping. That's what de-dollarization is about, right? But what happens if other countries don't need as many dollars? A de-dollarization of the world economy would cause a dollar glut, as I've just alluded to. The value of the U.S. currency would further depreciate. And I think at some point it becomes a self-perpetuating spiral or a death spiral of sorts, right? Where de-dollarization is devaluing the currency, and that is making people more and more wary of holding dollars, which is speeding up de-dollarization, right? They're trying to get away from something that is becoming weaker and weaker. And, if you get to the extreme, global de-dollarization could spark a currency crisis here in the United States. You and I would feel the impact of that through price inflation, right? Eating away the purchasing power of the dollar even faster than it is today. And if you get into the worst case scenarios, it could lead to hyperinflation. Now, I don't think that's going to happen overnight. But again, this is something that's playing out relentlessly over time. And if you're an investor, you need to consider that, right? Just because the tariff threat is over doesn't mean that, everything's fine, I can sell all of my gold, because you have all of these bigger picture things that are playing out. And if you have a devaluing currency, if you have de-dollarization, you want to do what the central banks are doing. You want to hold gold. You want to have real money in your portfolio, right? But you're not going to understand that if you're not looking beyond today or tomorrow, right? So again, the world doesn't have to completely abandon the dollar to create these negative impacts. Even a small drop in the demand for the greenback will ripple through the U.S. economy. In fact, a couple of analysts from Van Eck argue that we're already seeing some of the economic tremors due to de-dollarization, noting that despite its continued dominance, quote, the dollar has been devaluing relative to gold, an unprecedented trend. And why is it unprecedented? Because it has happened during a period of relative dollar strength and the absence of any real economic crisis, right? They say the current gold bull market is being driven by an erosion of confidence in the dollar. This is the analyst from Van Eck again. Quote, people in nations that have long used, coveted, hoarded the U.S. dollar are now losing faith and trust in the currency as a store of wealth. This shift began in 2008. When the global financial crisis led many to question the efficacy of the banking system and Western economic hegemony. It escalated with sanctions and freezing of assets imposed on Russia by the U.S. Other countries fear that similar retribution or weaponization of the dollar is possible for lesser infractions than the hostile invasion of another country. That really sums it up. But again, remember, this is bigger picture, right? This shift began in 2008. Right? Almost 2 decades ago now, or at least getting close to that. So it's not something that's going to happen tomorrow, but if you are investing, if you're not just trying to, make a quick buck on the swing of the market today, if you're trying to preserve your wealth and build wealth over the long term, you better be thinking about de-dollarization, right? You better be thinking about the debt bubbles and the malinvestments in the economy that are caused by the easy money business cycle. All of these things are important, and I think they get lost. They're obscured in this haze of, X threads So these aren't the only factors. Those are the three kind of that hit me as being the most significant right now. But I mentioned malinvestments in the economy that were incentivized by the easy money. That's all going to have to be cleaned out at some point. That's why you have recessions, right? That's one of the lessons of the business cycle. You get these cycles of boom where there's a lot of easy money and people are investing and everybody's doing great. And you end up with these malinvestments that end up having to be cleaned out, and then you have a bust. And the saying goes, the bust is often equal to the boom, right? If you have a nice big boom, you're going to have a big bust. So something to think about there. There's a falling demand for U.S. Treasuries, even as government spending keeps going up, right? The possibility of a bear market in bonds that Jim Grant is convinced is on the horizon. There's a lot of geopolitical uncertainty out there. You never know what's going to happen in, Russia or Ukraine or the Middle East or all of these hot spots. There's always possibilities of oil production shocks. All of these things factor into the economy. All of these things should be factoring into your investment decisions. You can't just knee-jerk on whatever you saw. Today you wake up and you see that gold's down $50 because, Jerome Powell said something. Don't just knee-jerk react to that. Put it in context. You have to learn to think slower in a world where you're being encouraged to think ever faster and faster. So, I often have to remind myself too, to approach all of this with humility. That was one of the things that Jim Grant mentioned in our interview, and you do, as you get older, you do start to learn, I don't know everything. And when you talk about the economy, I mentioned three important things that are going on. I could probably sit here and list hundreds of things that are playing into the economy. After all, the economy is made up of millions of people making millions of individual decisions, right? I can't project that. We can use modeling, we can use history, we can use economic law. We can understand to some degree, but we can't predict. I don't have a crystal ball, right? And I thought it was really cool because Jim Grant was very humble when he talked about this possibility of a bear market in bonds, because he acknowledged that things can always be different. He doesn't know for sure. And that is something that I think all policymakers, politicians, economists, we all need to come to grips with this. We all have a knowledge problem. None of us have all of the information and knowledge necessary to understand everything that's going on in the world. That's why central planning always fails. Because there's no way any brain box, right? No matter who put it together, whether you like their point of view or not, there's no way that everybody can process all of the information necessary to make good decisions. That's why I'm a free market guy. The knowledge problem, right? So, I can't possibly parse through it all. And I'm tying my hands even tighter if I fail to pay attention to the bigger picture while focusing on minutia, right? It's like one of those paintings that's made up of dots. If you get really, really close to it, all you see are dots. But when you back up and you get the full perspective, you see this beautiful picture. I think we live in a day and age where most people just see dots, and we have got to see the big picture if we want to be successful in our desire to maintain, preserve, grow our wealth, and to be prepared for things that are coming down the pike. You can't just make decisions based on the data you saw this morning, or the fact that you like this president, or what other narrow factors may go into your thinking. So, that's kind of the message for today. Step back. Think big picture, slow your thinking down, right? React when it's time to react, but don't overreact. Don't knee-jerk, right? Don't sell your gold just because somebody announces some policy change that may or may not come to pass. I think, again, looking at big picture, we've talked about the gold bull run. We've talked about silver being set up for an even bigger run. That hasn't changed. None of that changes with a shift in tariff policy. Might change the timing, but those underlying factors, things that I talked about today, inflation, debt, de-dollarization, those things are all playing out regardless. And so you need to consider those things. And I think that this gold bull run has a lot of leg left in it. And I think sell-offs are buying opportunities. Now, again, I could be wrong. It may be time for you to sell and take a profit. And if that's your position, then that's fine. We will buy your gold here at Money Metals, but we'll also sell you gold and silver. My recommendation is talk to a precious metals specialist today. Call 800-800-1865. Talk to a Money Metals precious metals specialist. If you're thinking about investing in gold and silver, they can help you figure out what products will work for you, how precious metals can fit into your investment portfolios. We have programs, folks that may not have $3,500 to buy an ounce of gold right now. We do have a program where you can buy gold a little bit at a time for as little as $100 a month. So those are the types of things that our precious metal specialists can help explain to you. But they're not going to explain it if you don't call them. So do that today. If you don't want to talk on the phone, you can go to moneymetals.com, chat with the precious metals specialist online. And if you don't want to talk on the phone, you just want to go buy some gold coins, buy some gold bars, buy some silver, you can do that right from the Money Metals website. So do that today. And remember, think big picture. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. You can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you can also listen to our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing, like Jim Grant. And if you like the show, first off, thank you so much for listening. I really appreciate the fact that you take time to listen to the show. If you like it, please go to wherever you're listening and leave a good review. Give us those 5 stars, crush those like buttons, share the episodes. It helps grow the show, it helps spread the word, and that's a way you can help us out. We really do appreciate it. Again, thanks for listening. We will be back here behind the mic again next week. Until then, have a great week.